Okay, going to talk to you about how do you get from 1 to 5 properties in the space of 2 years, 24 months. A lot of people might look at this and think impossible. I am here to try and prove those people wrong. So let's get into it. So pretty basic situation, okay? Someone who has $200,000 of savings, which is an awesome amount of savings, but not unreasonable or not unimaginable, okay? Someone who has a borrowing capacity of $800,000 to say $1 million, income of around about that 100,000 or whatever the amount is to actually get to that borrowing capacity. So about 100, 120, give or take. No student loans, no credit card debt, or no car loans. Student loans, that would be the only exception. Definitely the other two. Let's try and keep that without. Let's try and keep it as clean as possible. And then also renting with either a partner or with a friend. They're renting. Okay? Pretty basic. Here is how we at Fresh Start Advisory would position this person's portfolio if they came to us with that exact brief. Okay. Now, yes, they could go purchase $1 million property. I think in my last video, you would have seen that there would mean that all the risk is on that one particular property. Whereas this particular way is going to diversify the risk, and also it's going to get you into multiple assets, which, for this particular video, 5 is the goal. So let's walk through it. So pretty standard. I'm just going to use standard numbers here. Obviously, it's going to be very, very difficult to go and purchase 3 properties, let alone 5 properties at exactly 300,000. But let's just try it for simplicity reasons. So we're going to purchase a 300K property with a 10% deposit. $30,000 is obviously the deposit, 10% of 300. Then plus all your LMI, your stamp duty, and your bank fees, your buyer's agent fees. Closing costs, give or take, is going to be around $55,000. Okay, so that's the first purchase. Now, 2-month settlement, so 60 days after, go out, get finance again, and purchase the exact same property. Obviously, figures are going to change slightly, but let's say that the property is, again, going to cost $55,000. So there, out of that $200,000 that you have, the 2 of these properties, all up, closing costs cost you $110,000. Now, you're going to go and do that one more time, okay? This is what we would do for a client. It's what we do for clients, sorry. You go and purchase, again, another $55,000 of closing costs, another $300,000 purchase, okay? So that now brings this client's purchases and all closing costs up to $165,000. Okay, pretty simple. Remember, every single one of these properties, okay, would be having to put in at a minimum $5,000 in the client's pocket every single year. Okay, in the purchaser's pocket. Okay, so that's after all expenses. That's after your loan expenses, after your property management expenses, after your insurance, all maintenance, all other fees. The property's putting $5,000 into the client's pocket every single year. So obviously what that does, that means that borrowing capacity is it's not as affected as what it would be had you gone down the route of property costing you every year, and then your actual serviceability is not as affected as much, because obviously that $5,000 or $10,000 or whatever it is added to your personal income from the bank's perspective, okay? So over this time period, these 3 purchases, let's say that's taken 6 months, okay? 60 days in between PI and P2, property 1 and property 2, and then another, say, 60 days in between there. So all around, it is a 6-month process to get into the 3. But obviously that's only 3. The goal here is to get into 5. So how do we move from 3 to 4? Pretty simple. So P1, which we'll call it, property 1, that purchase was at $300,000, okay? $270,000 loan on that because it was a 10% deposit. After 6 months after property 3 purchase, we had the property evaluated. Okay. Now, conservatively, this property has grown by $60,000. Okay. Now, why I say conservatively is because a lot of these properties, we're now buying today, we'll purchase it at say $300,000 on a 3-month settlement. Come settlement, that property's already, 3 months after, that property's already $30,000, $40,000, $50,000 more. Now, obviously, that's purchasing in an area which is brewing and there's interest going in there, but also having the ability to purchase a property under market value as well. So there's that as well. So let's say after 12 months, this property is now worth $360,000. Okay, $60,000 uplift, $270,000 loan. That means there's $90,000 worth of equity, and obviously you can tap into 80% of that equity. Okay, without having to pay LMI again. So essentially, this client here has $72,000 worth of accessible equity, which he or she can tap into, which then is going to be used to purchase property number 4. Okay, now again, for simplicity reasons, we're going to look at a $300,000 purchase, a 10% deposit, and a $30,000 deposit there. So 10% of that. Okay, plus your LMI, your stamp, $55,000 closing costs. So this person here has taken equity from here, $72K, and had to spend $55,000. Okay, if that makes sense. Now that is property number 4. Let's move on to how we get to property number 5. If we go back here, okay, so the property number 1 has now been tapped into equity. So this is now very close to 80% LVR, loan to value ratio. So we can't tap into any more equity there. However, another 6 months down the track, property number 2 has also had the same uplift in growth. Okay. So we're now right at the 2-year period. Okay. Because we've taken 6 months to purchase property 1, 2, 3. Another 6 months later, waiting for property number 1 to grow in value by $60,000. So that's 12 months. And then now let's wait another 6 months after that, or 3 to 6 months after that, until we start to work with property number 2. Now, property number 2, again, worth $360,000, $90,000 worth of equity, 80% is actually accessible, so $72,000. And this is what we then purchase property number 5 at $55,000. Now, a lot of you might be thinking, okay, hang on, you've gone well over the 800,000 borrowing cap, or what you can actually borrow. Yes, remember there is other alternative ways to go down and continue to get credit, low doc route, and so on. And also remember that every single one of these properties is adding income to your personal income every time you purchase. Hence why the banks are able to give you more and more lending, because, excuse that, why the banks are able to lend more and more money to you, because every single time you're purchasing a property, you are adding income to your personal savings, to your personal income, rather. So this is how it looks. P1, we've purchased it, $300K. Value is that because we've tapped into the equity, that is the loan. P2, property 2, exact same scenario. P3, this is what it's grown by in the 6 to 12 months we've held it, $340. Again, P4, same. It's grown by $20,000 in the three months or 6 months that we've held it for, and same with P5. So now there's 2 ways you can go about it. You can sit on these, let them all grow, which they will grow, obviously, and continue to this snowball effect. Okay, this is really the beauty of property, how you can almost play Monopoly in a sense with it. You can continue to extract equity, purchase the next, extract equity and purchase the next, or you can then continue to use your own funds and continue purchasing. Or on top of that, you can call this the accelerator phase finished, and you can then start to consolidate, meaning you could sell down properties and pay off debt. Unfortunately, the property portfolio is not yet at that level because there's just not enough value to debt ratio there. So you would need to hold on, wait for those properties to grow further and further, and then until you could do that. But just know, simplicity. It's very, very simple, this process and this strategy, and it's worked time and time again. And it's absolutely not out of the question to have something like this done in a 2-year time frame. But it's not even about timing. It's just about how safe and how good the results are going to be. Whether it's 2 years, whether it's 3 years, it can be done, and absolutely is done day to day in our own business. So very excited. If you have any questions, let us know. And yeah, good luck. Bye-bye.